Hello and welcome to AI Market News by LM. Today we are really cracking open a dense stack of September 2025 economic data, and we're trying to answer one critical question. Is the U.S. economy actually stalling out, or is it, just shifting gears under all this pressure from inflation and high rates? We've got sources from the Conference Board, ISM, even the Tankan survey out of Japan, and honestly, the signals are pretty contradictory. Before we really dive in, though, just a quick but necessary note on how we produce this audio. This video's audio is automatically generated by NotebookLM, an AI-powered tool. The reference sources used in this summary are listed in the video description. As this content is AI-generated, there may be errors in proper names, pronunciation, or unnatural speech. This video does not provide investment or trading advice. Please make investment decisions at our own discretion. Okay, let's unpack this. When we look at the foundation, right, the U.S. consumer, we see some evidence of a pretty sudden and dramatic loss of confidence.
Yeah, that's really the clearest thing right out of the gate. The Conference Board data shows U.S. consumer confidence, it declined sharply in September, fell about 3.6 points to 94.2. That's actually the lowest we've seen since April.
Since April, wow.
Yeah, and what's really critical here isn't just the overall number, it's the component driving it down. The Present Situation Index.
Right, that's the one reflecting how consumers feel about the economy right now. And that saw a sudden shock.
Exactly. A seismic shock is a good way to put it. It fell by a significant 7.0 points down to 125.4. That's the largest single-month drop in a whole year. It really indicates that whatever happened in September, consumers felt this immediate sharp downturn, particularly around business conditions and, importantly, job conditions.
And their forward outlook, looking 6 months out, that isn't exactly painting a rosy picture either, is it? The expectations index.
No, not at all. It remains stubbornly weak, sitting at 73.4. And crucially, that number is still below 80. Now, for our purposes, 80 isn't just some arbitrary number. Historically, it's the tripwire. It signals a recession is likely ahead.
And it's been below that level for a while now.
Since February 2025. So this isn't exactly a fresh warning sign. It's more like a persistent 9-month-long alarm bell that just keeps ringing.
And if we dig into the specifics, the things driving this fear, prices and inflation are back at the top of the list in those consumer write-in responses, even though the average inflation expectation for the next 12 months dipped slightly from 6.1% to 5.8%.
Right, a slight dip. But the fear of daily price stickiness, that remains paramount. It's driving consumer perception of recession risk up to its highest point since May.
That makes sense. It's the real-world impact, isn't it? Worrying about tomorrow, sure, but terrified of today's gas and grocery bill.
Exactly. Today's prices are hitting hard.
Okay, but here's where it gets kind of baffling. The resulting behavior, the buying plans, they seem really contradictory. People are pulling back on discretionary stuff, and travel plans are down, car buying intentions weakened. But purchasing plans for homes actually jumped to a 4-month high. How do we square that?
Yeah, that paints a very complex picture of demand, doesn't it? It suggests, maybe a couple of things. First, perhaps it's only the really resilient consumers, those with disposable income who are still active, and maybe they see housing as an inflation hedge. Or perhaps they're anticipating a Fed pivot on rates.
Okay.
Second, for the average consumer, they're cutting back immediately on those higher frequency, maybe smaller, big ticket items like trips and new cars. That definitely shows immediate caution setting in.
And this consumer anxiety, it doesn't just exist in isolation. We can see those fears mirrored in how people feel about job availability, right?
Right.
Which connects nicely to the labor market cooling.
Absolutely. We see that direct link. The Conference Board specifically noted that consumers' assessment of current job availability fell. And it fell for the 9th straight month, hitting a new multi-year low. This lines up perfectly with what the job openings data, the JOLTS report, is telling us.
Right, the August JOLTS. Job openings basically held steady at 7.2 million. But if you look under the hood, you see specific areas softening up. Construction openings dropped by 115,000, federal government down 61,000.
Key sectors.
Key rate-sensitive sectors, exactly. And budget-dependent ones, too. And if we look at the quits metric, which is probably the most fascinating labor indicator right now, it suggests workers are losing that confidence to jump ship for better pay.
Oh, okay.
Quits were down significantly in accommodation and food services, dropped by 140,000 in just that sector.
And what's the clearest signal from that drop in quits? Well, the quits rate is really a key barometer of worker confidence. When people feel secure and see opportunities, they leave less desirable jobs for better ones. That drives wage growth. When quits fall, especially in a high turnover sector like hospitality, it strongly suggests people are starting to prioritize job security over chasing potential wage hikes.
So a real shift away from the whole Great Resignation narrative we heard so much about.
A substantial shift, yes.
Okay, so consumer nervous, labor market cooling. We should expect to see that reflected pretty immediately in business activity surveys. Let's pivot to the services sector. Huge part of the U.S. economy using that ISM data.
Yeah, and the ISM Services PMI provided one of the most sobering data points this month, frankly. It hit exactly 50.8%, right on the break-in line in September.
Yeah.
That's a 2-point drop from August, and it's the lowest services PMI reading we've seen since, well, January 2010, excluding the initial pandemic shock.
Wow, 2010. And here's where it gets really interesting, I think. It seems to validate those recession fears we saw in consumer expectations. The business activity index that actually slipped into contraction below 50.
It did, 49.9%. And that contraction is huge, it's significant. That's the first time that specific index has dipped below 50% since May 2020, right in the teeth of the pandemic lockdowns.
Right.
It suggests this systemic stress is finally showing up in actual service output reduction, not just slower growth. Things are actually shrinking slightly.
But despite that contraction, new orders somehow stayed just barely in expansion territory, 50.4, though they slowed a lot.
Right, barely positive, down 5.6 percentage points, so a big slowdown. But the employment picture in services, that remains pretty bleak. Contracted for the 4th straight month, down at 47.2%.
And the reasons businesses gave were interesting. Delayed hiring and trouble finding qualified staff seems like a contradiction.
It's a paradox, isn't it? Hiring difficulties combined with contraction suggests maybe specific skill gaps are getting worse as budgets tighten. But here's the major structural tension. Despite slowing activity, despite hiring contracting, the prices index still stubbornly high at 69.4%.
69.4. That means this is the 100th consecutive month of price increases for services. 100 months.
Yeah.
Where is that cost pressure still coming from, even as the economy seems to be slowing down?
Well, the commentary points specifically to tariffs still being an issue and these ongoing complex supply chain problems, particularly around advanced semiconductors and power components. Those continue to drive up input costs, especially in tech-heavy service areas like information.
So demand is cooling, but the cost base is just structurally higher now.
Exactly. Structurally inflated.
Which raises this important question then, is the economy slowing down uniformly across the board, or are we seeing something more selective and an uneven slowdown? Because if we look at the S&P Global Sector PMI data, the answer seems to be pretty sharp divergence.
Yeah, it's almost like the economy is split in two, right? One half is running marathon, the other half is kind of stuck on the starting line. 6 out of the 7 U.S. sectors they track still showed growth. Technology is absolutely roaring fastest expansion. Output index at 57.4.
57.4, that's strong.
Very strong. Financials also robust. Even consumer services gained momentum, hitting an 8-month high.
Wait a minute. So, is this really a total slowdown? Or is it just that the rest of the economy, construction, government, general services, is finally feeling the Fed's rate hikes? While tech and finance, maybe the least rate-sensitive, most specialized areas, they just remain kind of Teflon. Is that selective strength sustainable?
That really is the million-dollar question, isn't it?
Yeah.
The strength seems concentrated where capital flows easily. Tech and financials. It suggests this divergence might actually be widening the gap, the inequality between different sectors.
Okay.
And the downside of that divergence, it's clearest when we look at healthcare.
Okay, what's happening in healthcare?
Healthcare activity saw a renewed downturn. Its fastest reduction since May 2024, actually. And at the same time, it reported the sharpest rise in input prices in over 3 years. Higher inflation than any other sector.
Wow, costs spiking while activity contracts. That sounds like severe pressure.
Exactly. Rapidly rising costs plus contracting activity signals severe margin pressure and potentially, systemic issues for service delivery down the line.
So the narrative really shifts from just the U.S. economy is slowing to something more like the U.S. economy is bifurcating sharply. Winners being high-tech, capital-intensive sectors, and the losers are the core services and those rate-sensitive industries.
That seems to be the picture emerging from the September data, yeah.
Okay, this level of tension in the U.S. economy obviously has huge global implications, which brings us neatly to Asia and the currency landscape. Let's look at the data coming out of Japan. It provides that critical anchor for the USD-JPY pair.
Right. So Japanese industrial production for August, it fell 1.2% month over month. That's the second monthly decline in a row. The official assessment remains seesawing, basically bouncing around. Major drags were electrical machinery and metal products.
But the key metric here, I think, is the inventory ratio, right? Shipments were actually up slightly over 3 months, but inventory only declined 1.0%, and the inventory ratio itself rose for the third straight month by 2.5%.
Yeah, that rising ratio is important. It basically means goods are piling up faster than people are buying them. Or maybe production cuts just haven't kept pace with slowing demand yet. It's a classic signal of underlying demand's weakening relative to the stock on hand, even if manufacturers are trying to adjust.
And then we got the crucial Japanese Tankan survey for September. Gives us a look at corporate health, forward planning.
Yeah, the Tankan. Overall sentiment is stable for now. Large manufacturer sentiment edged up slightly to +13. Large non-manufacturers stayed flat at +34, which is still quite strong. However, the projection is for sentiment to soften a bit heading into December. But the key long-term signal, I think, is the continued strong capital investment plans for fiscal year 2025, projected up 8.4% across all industries. That suggests corporate Japan still has confidence in long-term growth, despite the current softer data points.
Okay, now let's connect this back to the currencies, especially the yen. The US data, as we've discussed, is messy. Cooling demand, persistent inflation, creates volatility for the dollar. How does this Tankan data help us understand the potential trading range for USD JPY?
Well, the Tankan provides a really clear baseline for corporate planning assumptions. Japanese businesses told us they're basing their 2025 plans on a pretty cautious currency outlook. 145.68 Japanese yen per US dollar, USD JPY at 145.68.
Ah, they put a number on it.
They did. And that corporate assumption, baking that high exchange rate into their actual forecasts, it acts as a kind of fundamental anchor. It reinforces corporate caution, sure, but it also suggests Japanese market players are prepared for and maybe even accepting of a relatively weak yen. That could keep sustained pressure on the currency pair.
So the market isn't just waiting on the Fed or the BOJ. Corporate Japan is kind of signaling the exchange rate they're already operating under.
That's a good way to think about it, yeah.
Yeah.
It provides a floor, or at least a reference point.
All right, finally, let's wrap up this deep dive by looking ahead at the immediate economic schedule. We're drawing from investing.com's calendar for the key U.S. releases this week.
Okay, yeah, this week is pretty front-loaded with central bank communication, and then it culminates with that big look at the U.S. labor market on Friday.
Right. Thursday looks like the big day for Fed watchers. We get the FOMC minutes released early. That's 4 a.m. Eastern Time. Then later in the day, Fed Chair Powell is speaking at 9:30 p.m. Eastern. Critical for hearing how the Fed is interpreting this bifurcated economy we've been talking about.
Definitely. We'll also get the weekly initial unemployment claims data Thursday evening, 9:3 p.m. Eastern as well. The expectation is around 223,000. Pretty steady, but definitely worth watching closely given that nervousness we saw in the consumer confidence data.
Absolutely. But the main event is undeniably Friday morning, right? 9:30 a.m. Eastern. That's when we get the mother load. The U.S. jobs report. Non-farm payrolls, NFP, expected around 51,000. That's a significant jump from the 22,000 we saw last month. The market will also be laser focused on the unemployment rate, expected steady at 4.3%, and average hourly earnings expected up 0.3% month over month.
Yeah, that Friday jobs report is going to be absolutely crucial for setting the near-term narrative for risk assets for markets generally.
Yeah.
If NFP comes in strong, it suggests maybe that selective strength in tech and finance is enough to overcome the cooling elsewhere, which could give the Fed more cover to maintain its tight policy stance. If it's weak, well, that changes the conversation.
Okay, so we leave this deep dive navigating an economy where the consumer is clearly nervous, especially about inflation. Labor demand is cooling, particularly in certain sectors, yet key parts of the economy, high tech, high finance, remain remarkably robust. The overall market narrative seems to be slowing demand, colliding head-on with persistent structural inflation pressures.
That tension, that divergence, really is the key challenge right now. And I guess the question for all of us to ponder is, if those traditional rate-sensitive parts of the economy, like housing, general services, construction, are contracting sharply, how long can the strength of just those specialized tech and finance sectors keep the headline job creation numbers positive? Is the weakness contagious, or is the strength somehow insulated?
A powerful thought to take into the new week indeed. Thanks for joining us for this deep dive. Don't forget to like and subscribe.